Hey, this is Neil, and I thought I'd make a video because I came across this question on Quora about why do stocks that don't pay dividends have value? And the guy's asking, if a company pays dividends, you can make a time value of money calculation and give it value. But if it doesn't, why would it have value? Shouldn't shareholders demand a company pay dividends to them whenever possible? And there's six answers here, and basically they are all saying different variations of the same kind of thing. That when you buy a company, it has intrinsic value because you're owning the assets or a share of the assets that that company has, plus any future business and expansion and all that kind of stuff. There's all kind of textbook things you will see in a finance book or a microecon kind of book. Um, but it's all kind of BS. So let's actually look at what happens. So you're an investor, right? And so this is you. And you spend a big chunk of money to buy a stock. Now, why would you do that? Whether you're doing it for yourself or whether you are managing a pension fund or an insurance company or whatever it is, you do that because let's take my stellar drawing here. You expect the stock to pay you back, hopefully more, right? So that can come in two different variations. Either the stock's going to pay dividends, or the stock is going to be sold for a greater price farther down the road. And if the stock pays dividends, then that's pretty straightforward. I invest $100, I get back $3 per year, and I expect that to continue. So my valuation is based on that cash flow. But if I'm planning to buy the stock or planning to sell the stock to somebody else, well, that's a whole different situation. So here you're spending money, right, for the stock. Let's call it an S. And then that stock goes to somebody else who spends money. And you get that money back. But why does this person do it? Well, it's because this person expects to either get dividends or to sell it to somebody else down the road. So, okay, so buyer B is now in the same position buyer A was. And it just goes on and on like that. And essentially, the questioner is right in that if a stock is not going to pay a dividend, and it never plans to, then that stock is fundamentally worthless because the only outcomes are that the company goes out of business, in which case the assets are liquidated, and in 99% of the cases, the stockholders get zero in that case because they're last in line for any claim on assets. Or the company continues to operate and just keeps reinvesting cash and spending it on things, and we're seeing that in Amazon and Google has decimated their cash um, with business ventures that have been loser after loser, but they make so much money on their primary business, it's kind of turned out okay. So yeah, if the stock is never going to pay a dividend, it's worthless, and that's the bottom line. But what has happened over the last, you know, let's call it 40 years or so, is that the the propaganda has been so successful that the the people believe all this textbook stuff. They say that, oh well, you're discounting future earnings, but you're not. You put in money, you get back money. That's all there is to it from an investor's perspective. And if the company's not going to pay that, then that's the end of it. You're not going to get your money back. Or you're participating in a Ponzi scheme. So, you know, if you truly believe that someday the business will turn around and they'll mature and they'll start paying dividends, then great. It actually happened with Apple, to the shock of everybody. Microsoft has started paying dividends. So it does happen, but in a lot of cases it doesn't, and that's one of the fundamental differences between investing and speculating. Investing is putting cash to work for a yield, whether that's now or in the future. Speculating is the capital gains game, where you are trying to offload all at once to a to a bigger fool, essentially. So that's my take on it. Plenty of people will disagree, I'm sure, but there you have it.